Super glad to be here and discussing exactly this topic because I think stablecoins are really the hottest thing in crypto and actually in TradFi this year. And I'm happy that we are continuing the discussion from the previous presentation where stablecoins were kind of explained. So we don't have to go through that, the different types of stablecoins. And we can just directly jump into the discussion of why are stablecoins so hot right now? Why is everybody launching their stablecoin? And we also have the Secretary of Finance, basically of the US, saying that he expects dollar-denominated stablecoins to reach $3 trillion in the next 2 or 3 years. So why is that? Why are stablecoins successful? And then we can move a little bit towards the risks. So who wants to go first?
I think I'm going to start just because I'm closest to you, I guess. I think there are I would say there are 3 reasons why stablecoins are becoming, they've been the main use case for quite a while. DAI, like the Maker's stablecoin, the white paper was actually published before the Ethereum network went live. So it's a use case that kind of predicates Ethereum in a way. So there are 3 reasons. One is, cheap international transfers. 2, there's a lot of demand for stable currencies, which in a global context typically means US dollars or like one-to-one redeemable assets. And then the 3rd one is yield. And I would say yield is the product and stablecoins are the use case.
Cool.
I would add that an overtone window kind of opened recently because the President of the United States signed an act that basically officialized that the US would not pursue a CBDC and instead they would push for private money, which means that it's basically an open bar for any private company to build their own banking system and to scale the dollar privately. It's going to be $1 trillion business. Multiple $1 trillion businesses are going to appear. I think a proof of that is that Tether just leaked that they're raising at $500 billion valuation. It's probably the biggest private company in the world. So it's very important to understand that the reason why everyone is talking about this is because of the opportunity that it represents on the market. And it's not like most of crypto was illegal or illegal. It's very much enshrined in the US because the United States is using private money as a way to scale the dollar dominance to the internet. The other thing to understand about this opportunity is that Ivan mentioned the yield. Money, at least stablecoins and deposits, banking deposits have 2 functions. One is savings, and the other one is payments. Savings is very much captured by banking. It's a huge industry. It is being disrupted by stablecoins. But the other one is payments. Payments is slightly smaller than savings today, so people have been focusing a bit less on it up until now. The reason why you might have seen a lot of fundraisers around payment chains over the past few weeks is because the potential for payments is 10 to 100 times bigger than savings over the medium term. So it's both regulatory opportunity and economic opportunity that makes this so big.
So, why is everybody launching their stablecoins? You have to imagine that banks, they want to attract your money. They want you to deposit money within their bank. And why they do this? Because, as you know, they make money with your money. When you want to create your own stablecoins, basically, you don't need to advertise it. You don't need to create credit card or all those products to attract people. Because everybody wants stablecoins, because everybody wants to make money. Because, I just speak about the yield now. Stablecoins, you know that with it you can make yield in DeFi with different protocols, with the issuer itself. So they are basically a liquidity sinkhole. So many companies, they wake up and they say, okay, how can I make money easily? I just launch a stablecoin. I back it with some bonds from the US or whatever. People will just come. I, again, don't need to advertise. I don't need to create a lot of services. I don't need to hire hundreds or thousands of people to run my machine. And people will just send me money. I will buy bonds. I will keep a big part of it, if not all of it. and I will redistribute part of it to my users. And this is why we have the explosion of stablecoins, because at the end of the day, if we forget about all the nice things like the payment and so on, it's also a pure cash machine for the companies issuing stablecoins.
Great, thank you. I really liked your replies to this one. So we already spoke about yield, and we know there are so many different types of stablecoins. So where is the yield coming from? Like, I would say in the most common way, like where is the yield that the user gets? I would focus on the user in this respect. Where is the yield coming from?
I mean, so if we talk about like the blue chip or the safe or real yield, basically conventionally or traditionally that has been coming from lending marketplaces that are on chain, like Aave, Morpho, Euler, etc. And then, to what Pascal mentioned, a ton of companies over the past couple of years have started doing like, oh, we're going to have T-bills, and T-bills are paying 5%, so like we'll give that to the holder of the stablecoin. Well, if you dig a bit deeper on the lending marketplaces, usually the yield comes from demand for leverage, right? Like one of the things that sometimes people, especially people who've been exposed to like a singular cycle in the market, forget is like ultimately a part of the industry that is kind of frowned upon of like, oh, like it's all about speculation and blah blah blah, and like, but you can have lending, and I'm like yes, the lending it is an amazing product and innovation, but ultimately the demand for it comes from someone somewhere wanting leverage. And with that, like it scales with the market cycle as well, right? Like when we're in a upward trend, yields go up to like 12, 15%, and that's safe end of the spectrum, and then we can get into the long tail assets later.
There's a cynical part in me that tends to think that it's all lending in a sense, because if you look at T-bills, for example, so bonds, as Pascal just mentioned, you're basically lending to nation states. Most of the actual yield sources are different types of lending. So you have crypto, overback lending, you have corporate lending, it's called private credit, you have T-bills, which is basically state financing, and then you have a few other like swap fees that you can get on AMMs. Basically, the yield comes from either lending, trading, and then the third option is incentives. That's, you have to be honest today that a big part of all of the industry is being pushed by all of these incentives. Airdrops, token incentives, cashbacks. So it's always been like this in a sense, but I think that where we have to be careful is that not all stablecoins are equal. This is a big part of why the regulation has been pushing a lot for what is the underlying of a true stablecoin. So if you look at the Genius regulation in the US, it's only going to be US bonds or cash deposits. If you look at what Micah wants to do, it's kind of similar. So not all stablecoins are created equal. It's very important to understand that. But the yield sources are kind of what defines the yield. And what we're saying is the higher the yield, the higher the risk, which is not surprising.
So it's a very good and important question, because when you want to buy a stablecoin, the first question you have to ask is from where comes the yield. So you have to do a bit of due diligence. For example, we just spoke about a stablecoin called USD AI. So when you first stumble onto this stablecoin, you're pretty happy because it pays a very high yield. So you may just want to get into it. But again, you need to know from where the yield comes from. So you have to do some research, and you realize that the stablecoins is basically, again, like a bank. You give money to this company gives you a stablecoins, and the yield comes from them lending money to AI company, data centers, and so on. Which means that if you lend money to someone, there is a risk that this someone will not pay you back. So, for example, for this specific stablecoin, I prefer to don't use it because my risk tolerance will reach its limit. But yes, so you have some stablecoins from the yield comes from lending the money to someone else. Of course, you have what we discussed, the yield coming from the bonds and so on. But in general, the yield is always coming from the backing, so the collateral. So your work as a DeFi user, as a protocol builders, is to make your research to understand what is the collateral, is it risky, and so on. And if you can't find it, it means that the yield comes from you, which means that it could be a Ponzi or it's just a token printed out of thin air and so on.
I think like this hits on a very important aspect of the industry that somehow is, because it's not quantitative enough yet, sometimes gets overlooked, but there is always implied risk premiums on like long tail type of stablecoins, right? Like if USDC pays 5% and you have something like the AI thing, it's like they cannot get away with less than 20 plus just because people are like looking at it and like, okay, like the chances of this not existing until the next market cycle are pretty damn high. So it should be a lucrative opportunity at the moment on like a shorter time frame. So we'll have this sort of separation of here are some assets that are trusted, although we're aiming to build trustless systems, etc. But like trust plays a huge role in it, right? So there is a part of the asset space that is pretty trusted, and you know, like the yield required there is not as high. And then you have on the other end of the spectrum, you have these like more aggressive opportunities. So it's it's a spectrum, and ideally over time we'll see who sticks around, and that the projects that manage to sustain like operations, they will probably see the yield required by the market for their asset go down with time as they accrue Lindy.
I think that's a very important point. Yield doesn't scale as much as we think, in the sense that the more demand you have, the bigger you get, the more yield are going to get constricted. Traditionally in finance, we tend to see that very competitive opportunities where risk is progressively seen as lower tend to compress around 4, 3, 2%. So when you're seeing over 10, over 20, over 100% yield, there's two options. Either it's a scam, or it's very new and it's very quickly going to contract. So you're not actually going to get that yield that's advertised, because most of what you're seeing in crypto is real-time yield. So it can get contracted really high if the risk reward is too interesting for people. Yeah, that's true. Someone can just come in with 300 million and like a hedge fund, because people are specialized in doing this and they just arbitrage the yield very quickly. So it's never too good to be true, in a sense. And I think the whole challenge is when you're getting these new yield sources, up to where can they scale to a relative size. If you look at Ethena, for example, which has been the breakout success of the past year or two, they are kind of constricted by the actual size of perps in general in the market, which is, I think they're at the maximum size right now. So most of the projects that get to such size, what they do is they diversify into T-bills, because these can scale into trillions.
And talking about perps, I would like to get your opinion on one of the hottest projects from, I think even from the last cycle, but currently one of the projects in DeFi that are actually generating revenue, and that's Ethena. And they have a very interesting model, and they are now entering the TradFi scene, or trying to enter TradFi. So just quickly, I would like to understand, like, where would you put Ethena on the risk spectrum, having in mind, the way it's collateralized?
So I think it depends on how you assess the risk. In my viewpoint, Ethena have already been battle tested. They have been through some shitstorm. There was an issue with the hack of the exchange they were using, but we saw that they were prepared for that because their funds were not in the exchange. And so on part of the execution of the risk management, I would say that they are on the highest curve of the low risk. I can't say they're more risky or less risky. I mean, they are not less risky than USDC, but let's say they will be on my second level.
Yeah, I'll tend to agree with that. I think like
On a scale from 1 to 5, let's say. I guess in your scale, it's like, okay.
It's
okay.
yeah. I would probably place them in the same place. I think because of their sheer scale, they have to rely on a large network of partners and venues and custodians and exchanges, et cetera, et cetera. So a single, like even if a counterparty of theirs collapses, just the exposure that they have to each counterparty is relatively constrained because, yes, they might be the largest business relationship of that counterparty, but that counterparty for them represents like a small fraction of what they are doing. And you know, let's say you have like 10% of your business is with a single counterparty. Even if that fails, there is enough equity in the business that, you know, I can see them like they'll keep going, and they'll like over a couple of years through the yield they'll just recover the, you know, they'll plug the hole, which is something that so Tether had another business called Bitfinex back in the day, and like that's sort of a situation that they had there, right? They got hacked, and then people that suffered losses, they were just issued a receipt that over time, through fees generated by the exchange, they got paid back. And I think Athena is in a position where, like, even if there is an event, they have enough cash flow and they're like a profitable enough business that they'll be able to plug that in.
Yeah.
If they want to. My assumption is that they do.
Oh, I think your assumption is right. They wouldn't kill their business for this. But the part where I don't agree is to classify USDE, Athena's digital synthetic, as a stablecoin. Stablecoins, legally speaking, are basically the equivalent of banking deposits. What Athena does is closer to what a hedge fund does. So the risk is, I think it's better to think that Athena started as a tokenized yield source, and they've progressively been getting closer to what a bank looks like because they're allocating to multiple yield sources. Right now they're into the SUSDS from Sky, and that used to be called Maker, and into their own yield source. So the thing is, if you compare it to risk of a traditional stablecoin, you're basically conflating the fact that they are fundamentally taking more risk. Their team has proved operational excellence. They have an insurance system. They have an equity buffer. So they are very different from projects who might want to do similarly to them because they've passed a threshold in a sense. But comparing them to actual stablecoins is a very dangerous slope, which has opened an Overton window for a lot of projects to get into it. And that's why I mentioned previously that there was stablecoins and synthetic dollars in a sense, because the truth is the risk profile is very different. Even if it's low in a sense, it's still very far. And I would say by an order or 2 orders of magnitude from something like Circle or Tether.
Yes, I completely agree. Actually, on the side of Athena, they present themselves as a synthetic dollar, but I know that a lot of users don't really, you know, see the difference or understand the difference. Okay, so when I was opening the conference today, I mentioned that, you know, the whole financial system through tokenization, through stablecoins, because stablecoins basically is tokenization of dollars, is going on-chain, and Vitalik had a piece recently called, well, it wasn't called low-risk DeFi, but he introduced this concept of low-risk DeFi, which I assume is, you know, this compression of yield due to the increase of trust in time, and Ethereum being the place where, you know, stablecoins can get away with lower yields because the trust in them is kind of higher. So what do you see happening with stablecoins in the future? Do you expect most of those to be collateralized with traditional assets? Do you expect more, you know, synthetic dollars happening? And yeah, like, what do you see happening with regulations? You mentioned the Genius Act, and it was kind of, as far as I understand, the Genius Act was kind of agreement between the DeFi sector or crypto sector and the incumbents, the banks, of, you know, allowing these stablecoins to exist, but then not having yield connected to them. And so regulation kind of shapes the future of where stablecoins are going. So what do you think is going to happen in the next 2-3 years with stablecoins? What kind of stablecoins do you think will be mostly used?
So my viewpoint is that crypto collateralized stablecoins will be like DeFi. It will remain a niche for us, for crypto people, for people who are okay to put some crypto assets as collateral. But most of the stablecoins will be collateralized by real-world assets, either bonds or just cash in a bank or whatever. And it's just because who will be the users? It will be companies, it will be you and me, it will be your families and so on. And they don't want to take the risk of the volatility of the collateral. So this is what I think about DeFi in general. Like there will be two DeFi now, DeFi for us, the nerd and so on, or DeFi power users. And we are okay to take the risk and to do very weird stuff on chain. But then there will be the DeFi that should power real use cases, payment and so on. And this we can't take the risk to have, even though I love DAI and liquidity and so on, no, they will be using USDC, Tether and other things.
I think it's pretty obvious. It's also a shame because we've kind of lost over the past 2-3 years the weirdness that used to be built out. I really hope it's going to come back. But what we can expect is a major shift. The Genius Act you mentioned, MiCA in general, they're pushing for stablecoin issuers to be very similar to banks. They're basically opening the door for almost exclusively only banks to be able to afford to build these out. Unfortunately, a lot of these projects will quickly die out, the ones who are specifically T-bills backed, etc., because we are off from a high of what interest rates were for T-bills, especially in the US, but everywhere in the world. So we had the first rate hike down of 25 BPS last week, 10 days ago, and it's going to keep going down, and basically all of these projects are going to see their margin being contracted very hard, and they're going to have to be much more creative with their business model. I think a lot of them won't be able to do it. A lot of projects will go with more exotic collateral, which, by the way, is not legal as of now. And by doing so, they're going to take more risk. It's going to lead into something where people were led to believe they were in very safe stablecoins. Then these are probably progressively going to get riskier and riskier. In essence, the only edge that an asset manager, an asset issuer has, and is going to keep having outside of the network effects that are being built out, is basically risk management. So we talked about Ethena before, but projects who have built very heavy risk management are going to be the winners.
Yeah, I think, the way you introduced the question with like the Genius Act being an agreement between DeFi and TradFi, like I disagree. I think the Genius Act is like how TradFi is trying to kill DeFi in the shape that we have today. It's basically like they're trying to create a legal mode where it doesn't exist yet to like make sure that they're the sole issuer of stablecoins. Actually, it's 2021. Like the German Minister of Finance on a G7 summit said that we should do everything possible to keep the power to issue currencies within nation states as a response to what was happening in DeFi at the time. And basically, this is like the concession of governments now is like, okay, we'll allow private money, but private money will be issued only by entities that are, tightly coupled with governments. Like it's unclear who controls who, but like they're very tightly coupled. And the nerds that are doing stuff on chain will try to like push them in a corner. It's not a very aspiring view for the future, but like that's probably what's going to be the 80% of the market, and the remaining 20 are going to be like niche things that we do on chain. And that's I think that's the most likely outcome of the future. And we're seeing like the importance of distribution even beyond legal modes, right? Like Stripe launching their own network, and it's a play to circumvent Visa and MasterCard, right? Because they have a big enough network that they can deploy their own blockchain and they can deploy their own stablecoin and like tap into the payments use case without ever touching DeFi or like honestly, like arguably not even using a real blockchain.
Just wanted to add something also. Even though most of the stablecoins will be created by TradFi, there is something very, very interesting and funny that is happening right now and will keep happening. If those stablecoins issuer, they want to have some success, they still need DeFi power users. And it's very funny to see them that they come on Pendle, or I'm pretty sure you saw like 2 weeks ago, there was Hyperliquid. They wanted someone to deploy a native stablecoins on Hyperliquid. And you had very respectable TradFi guy with a suit and cravat and so on, who come on the Discord of Hyperliquid speaking with a cat, with the NFT and so on. And even though it will be maybe TradFi who will mainly issue stablecoins, they will still have to comply to deal with a pure DeFi nerd. And this is why there will be this interesting and funny overlap.
Just because I have a few more, but the time is running out, do you think the Genius Act is a positive step or is it negative? Positive or negative for the DeFi space, for the DeFi user?
Honestly, it depends what your bags are.
Okay.
I think that's the best answer you can get.
Okay. And then finally, because I wanted to ask you about, in this in this space or state where the T-bill yield is going down, what do you think is going to happen with stablecoins on chain? But you kind of replied to that question. But do you expect a large influx of stablecoins into DeFi, maybe like just quickly in the next couple of years? Like where are these $3 trillion of new stablecoins going?
Well, right now, when you look at innovation cycles, we're entering the synergy era. So it's basically, we have working tech, we can actually do things with it. So how do we make it compatible with what works today? An example, there's a chain launching tomorrow called Plasma, who announced Plasma One, which is basically a neobank. And what these guys are trying to do is creating savings accounts for countries that want dollar but don't have access to it. So countries with very high inflation, like Turkey, like Argentina, and their whole point is, okay, people who are earning their wage, they're struggling to get dollar, so they could just unramp very quickly and get all of their savings into dollars, far away from banks in their country that could just seize or freeze the dollars they would have, because these are highly valuable assets in countries where money has a hard time in being managed properly. So you can just start by doing this. Then you have all of the payments, all of the remittances that are done from Western countries into any other countries in the world, for example, from the US to South America. It's going to go very quickly. Then you have all of the lending. Earlier this year, the US announced that they would allow Fannie Mae and Freddie Mac, who are the mortgage, don't really call them companies, but institutions that enable mortgages in the US, that they would allow ETH and BTC to be used as collateral to buy a house. You have a project that's called Pawn, who just announced that they would do mortgages on-chain. So just progressively bringing all of that financial system onto crypto, on-chain, will enable trillions of dollars of stablecoins to appear. And in other currencies.
Yeah. And yeah, I like that. Any other currencies and other currencies. And in relation to that, or Pascal, do you want to take this a little bit more to expand? Okay, so I'm going into the area of central bank digital currencies. Because we know that there is a digital euro coming up, I think it's going to happen in like the first issued digital tokens of the euro, like digital euro tokens will most probably happen to 2027 or something like that, so there is time. But when we're talking about central bank digital currencies and stable coins in this era of the Genius Act, of heavy regulation, what is better? Is the fact that the US have said that they don't want to issue a central bank digital currency a good thing? On the background that they're going to be issuing so many stable coins. So are stable coins better than central bank digital currencies? And why or why not?
Of course, it depends how you see the world. From my personal point of view, I guess we share the same country, have of course the right to print money, and they should do it. but they should allow let us play with DeFi, and stablecoins on DeFi should be like a common good. Everybody should be able to use it. Like Romain was saying, it's awesome that anyone in the world can get access to dollar or any currencies. You just need internet connection, and boom, you have dollar, you can have yield. And this thing, it's like one of the biggest innovations, and we shouldn't abandon it. So I'm not against CBDC. Of course, I'm not a huge fan because it's increased control from countries and so on. And of course, I would prefer a world where we have more freedom and we have our own responsibilities and no one is dictating what to do with the money. But yeah, then it will depend, of course. In Europe, we have different way of seeing things. In the US, as you said, it's more liberal. But
yeah. I don't see like private bank issued stablecoins to be meaningfully different than central bank stablecoin, right? Because ultimately the central bank arguably should be controlling and like monitoring and in charge of whatever private banks are doing. So it's a better distribution model, but fundamentally I don't see them as different products.
That's a good point.
I see them as different products, but I agree with everything else you just said before in the sense that in the end, the stablecoins who are going to be allowed to thrive will be regulated, exactly like the banking system, which means that the end goal for states can be very similar. It's very much an ideological question, so basically liberalism versus state control. Something that we really have to take into account is even if people are doom posting about CBDCs and the ECB just announced that they were very serious about a euro stablecoin, they started working on it. There's a very big difference between the speed at which a startup operates and the state at which a state or a national institution operates. I don't think we'll have a digital euro in 2027. We'll have the digital sandbox test mode in 2027. It will not be live before 2028, 2029. Considering the speed at which dollar private stablecoins are scaling right now, it is very obvious that the market will be in a very different place in 3-4 years. And it is unlikely that CBDCs are commercially successful in the next decade because of this. They're going to be too slow. I think they are necessary. The arguments that the ECB has in having a digital euro specifically for retail is good for protecting customers and users in general. The problem is that we are going to relinquish most of the monetary sovereignty to the dollar in the coming years. And it's becoming very clear this is inevitable today.
Yeah, that's a very, very good point, because the speed of innovation with stablecoins that is being unleashed now with the Genius Act is gonna completely annihilate any chances of, I would say, a European like stablecoin, well, not stablecoin industry, but the expansion of euros in this new digital world that more and more people are using. So in my opinion also, this idea of the European Central Bank that the digital euro will be the reply of Europe to, you know, the dominance, the almost complete dominance of the dollar in the digital space is just completely misguided, and it's going to lead to potentially the euro losing even more market share in the next couple of, although I'm not sure if it's possible, because I think when it comes to stablecoins, it's 0.4 to 0.2% of the entire market cap is digital, is stablecoins pegged to the euro. So this idea that the digital euro will save the euro in the digital world, in the upcoming, you know, blockchain era, I think this is completely misguided, and this lost time of 4 years that you mentioned is going to come back and kick Europe in the ass. So
it's basically the equivalent of like having an argument at work and then in the evening under the shower you're like, God damn it, that's what I should have said. Like that's what it's going to be.
Yes, exactly. I think we have like 4 minutes, 5 minutes for questions. So anyone from the audience, you can scan this and and we have one that maybe we can give you a microphone there. Whoa, okay, perfect. I have them here. Yeah. Maybe a microphone to
Please
there, and
don't
I'll
ask us-
continue on Slido.
Please don't ask us anything that would send us to jail.
I thank you for the great discussion. My question is brief and it's mostly a matter of semantics because we've already been through the cycle in traditional finance where we've seen the precedent of negative interest. Would you say that in a stablecoin market or a stablecoin system, a negative yield or a negative interest would count as a DPEG event, or it's just going to be rebalanced?
It's unlikely it happens because it would mean that people are so confident with a country's obligations, T-bills, that they would basically be ready to pay to give them money. Considering the state of the world right now, it's very unlikely any country gets in this situation. It might happen if we get another, I want to say, golden age. But if you look at the state of the global economy in general, we will likely not see negative rates for a very long time. And theoretically, we should not even ever have seen them. But you're right, there's always these kind of things that will break stablecoins. When we say they're battle tested, it doesn't mean they're tested for every occasion. And in a sense, yes, the projects would have to depeg if they didn't have treasury. But probably what the companies would do is they would not allocate to these kind of assets if it happened.
Thank you.
Yeah, we have a couple of more here. One is, again, relating to what's going to happen with stablecoins in a world of negative interest rates. But that's maybe the same one. And then the next one is MiCA and the influence on launching stablecoins. I guess euro-focused stablecoins. Is MiCA helping, or is it actually the opposite, making it harder to launch a euro-pegged stablecoin?
I think you're probably the only person who's read the whole thing, so maybe you should take this one.
I'm not speaking as a lawyer. I'm being very clear on this. And also I heard doing this meant yes here. So it's very much the French way of saying no. We've seen this happen with ICOs that were regulated in France in 2018 with the PAC law. The people were convinced that creating innovative regulation would help and being the first would help. What we're seeing again is no one is incorporating stablecoins in Europe. It's just not possible. People are barely succeeding in being compliant for becoming what we call PSAN, CSAP, basically digital asset providers. The truth is, if regulation is too tough, which it is, it basically leads to not having local actors, and then we basically have to rely on external actors. The irony is not just that, for example, we are dominated by dollar stablecoin, but the only relevant euro stablecoin is built by Circle, which is an American company. So we are so far down that we don't even have sovereignty over our own pseudo-sovereign assets. So no, there's like two assets that are MiCA regulated today, and they're both Americans. It's not working.
Yes, thank you. I see one that just came in. Well, there are many coming in, but I don't think we'll have time to reply to all of those. Maybe last one. What will happen to CeFi exchanges or DeFi liquidity when there are 5, 10 major stable coins? Would that dilution of pools or pairs on CeFi exchanges cause issues? So I guess Bitcoin to 10 different stable coins, or Ethereum to 10 different stable coins, or any asset to any different stable coins.
I think on-chain, that problem is going to get solved more easily. We're building something around that sort of solves this. I believe like a lot of projects are tackling this for on-chain pairs. I think for CeFi, it will basically, they'll just take the approach of have direct redemption with issuers treat those as equal assets, and like the user is not going to see 10 different stablecoin pairs on the exchange. They'll choose which one they want to do. They want to transfer when they're like offboarding or whatever. But like within the interface, we'll reach sort of like fungibility of stables, where like the exchange would have direct redemption, and the others are not just gonna get delisted. So it's gonna get to a consolidation point where you are either big enough to be relevant or you just die out. And we saw that during like the 2022 to 2024 bear market, like a lot of projects that were not at sufficient scale to survive, they just died out, and we'll probably see that with stables. Like a lot of the demand that Pascal was mentioning of companies like launching their stable coin, like Walmart, because they have a big treasury or like balance sheet, they launch a stable coin, they harvest the 5% yield goes to zero, they'll be like, fuck it, it's not worth it.
Yes, there are many questions that I want to ask you, but we are kind of low on time. Just final one, and just with one sentence, if possible. Logarithmic stablecoins. Do you expect more experimentation in this area after the collapse of Terra Luna? Yeah, algorithmic stablecoins. Are we gonna see experimentation, or Terra Luna just killed them all?
I mean, I want to see experimentation, not necessarily around algorithmic stablecoin. I want to see more around exotic currencies, so creating what we call floating currencies. I think this is where things get very interesting. I do think it's going to be less intense than it was over the past 3-4 years because of regulation.
I think algorithmic stablecoins had their time when we didn't have other options. Today, we have so much yield that we can make with normal stablecoins that apart from creating a community and having fun, I don't see a point to have algorithmic stablecoin.
Okay. Well, guys, please thank our panelists.